Hey everyone, today we're going to talk about how to maximize tax efficiencies using 529 distributions and coordinating them with the American Opportunity Tax Credit. We're especially excited about this video because it's our first ever YouTube video and it's a special edition one in honor of May 29th, 529 Day. It's a little bit outside of the scope of our normal business owner tax planning strategies, but hey, even business owners have college students as children. So we're going to start off by giving a quick background info on 529s and the American Opportunity Tax Credit. Then we're going to go into a quick calculation to demonstrate how the American Opportunity Tax Credit is more tax efficient than qualified distributions from a 529. And lastly, we're going to talk about some strategies to maximize the tax efficiencies. Many of you already know the benefits of a 529 from you having a 529, so we're just going to give a quick recap. There's two different types of 529s. There's a prepaid one, something like the Texas Tuition Tomorrow Fund, and there's the other type of 529 you get through a financial advisor that invests in mutual funds. The neat thing about a 529 is that the distributions, the earnings, are tax-free when used for qualified education expenses. As many of you probably know, the American Opportunity Tax Credit is a refundable tax credit that allows you to use a 100% tax credit on the first $2,000 of education expenses and a 25% tax credit on the next $2,000, giving you $2,500 tax credit on $4,000 of qualified education expenses. There are some important caveats, however, such as it's only available for taxpayers with an AGI less than $80,000 or $160,000, single and married filing jointly, respectively, and it phases out completely once you reach $90,000 or $180,000, single and married filing jointly, respectively. Also, it's not available for married individuals filing separately. Now it's time for the fun part, the meat and potatoes. Qualified education expenses differ between the AOTC and 529, so this is how we can use it to our advantage to maximize the tax efficiency. So room and board expenses you can use for the qualified distribution from 529s. However, you cannot use room and board expenses to take the AOTC. And there's no double dipping. In other words, you cannot take the AOTC for expenses that you took a qualified distribution from the 529 for. So, how do we put all that together? Well, you pay tuition and fees out of pocket or from sources other than a 529 while paying for room and board expenses from your 529. And that will help you maximize the AOTC and qualified distributions. So if you're a skeptic like me, you might be thinking, you know what, James, that doesn't apply to me. I have a big enough 529, or I got it covered, or I don't have current cash flow to pay for these expenses like tuition and fees. Fret not, let's go through 3 quick cases so I can show you how you can still maximize these benefits. So the first scenario, as I mentioned, is where you have enough in a 529, but your cash flow poor because you got other things going on. You have life, right? So what we're suggesting here is to carve out $4,000 from your 529 to pay out of current cash flow. But you might not have the current cash flow. That's okay. You can take a student loan to pay for those expenses because, as I mentioned, you can still take the AOTC for expenses paid for a student loan, and you get to use the AOTC for the year that the expenses incurred, not the year where you repay the loan or where the loan, or when you actually get the loan. The other scenario you might be thinking is, okay, well, I'm paying from a 529 and current cash flow. Well, then that makes it even easier to maximize the tax efficiencies. You might have to rearrange the way you're paying those expenses. So you might want to pay for tuition and fees straight from cash flow, and you might want to distribute from your 529 to pay for room and board expenses. The last scenario is where you might have a student in college right now, but you're still contributing to a 529. You probably want to cancel your contributions to your 529 and pay it directly to the tuition and fee, or pay it directly to the university for tuition and fees. The reason being is that, again, you cannot double dip and the AOTC is more tax beneficial. So by putting your money into the 529, you're pigeonholing yourself into the less tax efficient vehicle. While everything we shared today is based on today's tax law, By the time these little ones are in college, I'm sure the tax laws will be different. So please stay in contact with your tax pro, your financial advisor, to stay abreast of all these tax law changes and make sure you're taking full advantage of it. Thanks for tuning in to Adaptive Tax Planning channel. That's our 2 cents on your tax dollars. Stay tuned and please subscribe to our channel. Thanks.